A reminder that next week's lecture with Mr. Dust of IDEO will be in here next Friday morning at 10:40 a.m. Today's lecture will be similar to our opening session of 2 weeks ago in that we will view the second half of Professor Neil Ferguson's PBS video, The Ascent of Money. Following roughly 45 minutes of video lecture, we'll turn to our two guests today for comment and then to you for questions. John Rosenthal currently serves as Chief Executive Officer and Managing Member of Rosenthal Partners Capital Advisors and has been in this position since July of 2009. Prior to that, Mr. Rosenthal was Chairman of the Advisory Board of Directors for the Northern Region of Old National Bank. Prior to that, he held the position of Northern Region CEO and member of the Executive Leadership Group for Old National Bank. Mr. Rosenthal was Chairman, President, and Chief Executive Officer of St. Joseph Capital Corporation and St. Joseph Capital Bank from 1996 until its successful sale to Old National Bank Corp., the parent company of Old National Bank, in 2007. During his tenure as CEO of St. Joseph Capital, the bank grew to $500 million in assets, 80 employees, and more than 2,000 clients. Mr. Rosenthal is a graduate of the University of Notre Dame and a former faculty member of the Graduate School of Banking at the University of Wisconsin. Paul Schultz is the John W. and Maude Clark Professor of Finance at the University of Notre Dame. He received his BA from Macalester College and his MBA and PhD in Finance and Economics from the University of Chicago. His expertise is in corporate finance and market microstructure. His recent research interests include the collapse of internet stock prices, arbitrage, and the prices of dual-class shares, as well as the ability of mutual funds to pick stocks. Let's begin this morning with the second of our video segments narrated by Harvard economics professor Neil Ferguson from The Ascent of Money.
Neil Ferguson is a historian. He's not an economist, so he takes a historian's perspective on this. As an economist, I listen to it and I feel like, he's got the words, but he doesn't have the music. That he really misses out on a lot of things or doesn't have a deep understanding of a lot of these issues. With respect to the bond market, he talks about the bond market a bit, and he makes statements as well as I could jot them down while he was speaking. Real power lies with the men who control the world's bond markets. And the bond markets dictated the defeat of Napoleon at Waterloo and ensured the defeat of the South in the American Civil War. That's kind of the wrong way to look at it in that, bond traders control the bond markets in the way that, surfers control the waves. What's really moving the bond markets is the underlying economic forces of inflation and economic growth. When politicians are critical of the bond markets, they're critical because the bond market's the messenger, often delivering news that they don't want to hear, that their policies are not working out, that they're inflationary, that they're unsustainable, and so forth. But I think it's kind of a distortion to say that Bill Gross or anybody else determines bond prices or has power in that sense. With respect to the options model and long-term capital, he talks a bit about Myron Scholes and Robert Merton and long-term capital. My first year as a grad student, I was fortunate to have a class in option futures from Myron Scholes. And as a teacher, he was just awful, just among the worst you've ever seen. And the reason was that he was so busy with consulting and doing other things, he just never prepared for class in the least. So he would walk in each day, look at the syllabus, and just talk off the top of his head. So, for example, one day he's talking about trading in response to taxes and tax trading strategies. And he says, first we need technical definitions. So he goes over the board and he writes long-term capital gain, a gain that is taken long-term. Short-term capital gain, a gain that is taken short-term. So those are his technical definitions. And there's another time he went to derive the Black-Scholes model, got confused in the middle, sent the class away, and we had to do it again the next day. But with respect to the Black-Scholes options model, that forbidding formula that is written there, there are three people really involved in it. Fisher Black, who's not mentioned here, Myron Schultz, and Robert Merton. Robert Merton formalized a lot of the math behind it. And Schultz and Merton got a Nobel Prize for that, and they deserved it. It's that fundamental and that important. Fisher Black had died the year before. It was kind of a sad thing in that everybody knew he was dying. He had throat cancer, and people who won the Nobel Prize in economics are bugging the committee, give it to him this year because he's not going to be around very long, but they waited till the next year after he had died. But anyway, Fisher Black and Myron Schultz, despite all the math, the real contribution they made was this. They realized that if you held the options and the stock in the proper proportions, then over short periods of time you had a riskless hedge, and that would earn the risk-free interest rate. And that was the missing piece that was needed to price these options. So having that insight that you could earn a risk-free rate of interest in a riskless hedge, they went on to derive a partial differential equation that would explain the value of the option over time. And as Myron would say, this is not your typical high school partial differential equation. It was difficult, and they couldn't solve it. So for 6 months at least, they had the model. They were trading on it by approximating through various ways, but they could not solve it and come up with the Black-Scholes formula. Finally, they showed it to a physicist who said, oh, that's the heat transfer equation. Here's the general solution. And that's where the solution came from. Apparently, Einstein had come across the same equation in 1905, and he solved it and had lunch or whatever. Black and Schultz have been messing around with this for months before they were able to solve it. So that's the Black-Scholes model. It had really nothing to do whatsoever with the collapse of long-term capital management. And it's really not entirely accurate to say that Schultz and Merton really had much to do with that. They were partners in the firm. They did a lot of consulting. They were involved in the firm. But it was really started by John Merriweather, a Salomon Brothers bond trader. And Schultz and Merton had little to do with the day-to-day operation. And what really brought them down was trades and things unrelated to options. They were making bets on interest rates in different instruments and in different markets. And the problem was that whereas it looked like they were making several thousand different bets, they were really making the same bet several thousand different times. And when the Russian debt crisis hit, long-term capital was highly levered, and they lost a lot of money very, very quickly. The last thing I'd like to mention is that Neil Ferguson talks a lot about euphoria and fear in stock markets and other markets. It makes it sound like that's what's really driving financial markets all the time. It's not. Most of the time when stocks go up or down or other assets go up and down, it's in response to information. And often this is private information or people's opinion or interpretations of information, which is really hard to identify. But it's really, I think, misleading to think of it all as people panicking or people being euphoric. If you look at the dot-com stocks in 1999 and 2000, we look back now and we're saying, geez, you have, there were 3 online sites devoted to selling pantyhose, selling at huge prices. And we look back now and we think, this is really insane. Why were people paying for that? But if you go back to what people knew in 1999 and 2000, and you see the phenomenal growth in internet revenues and sales, you can see why there was so much excitement and why it looked like this was going to be a tremendous new sector of the economy. So it's easy to identify after the fact that people were overly optimistic or too pessimistic. Very easy to identify after the fact. But it's very hard to make money on it in the present time because, in fact, things are a lot less certain than he makes them out to be. Thanks.
Thanks, Paul. We turn now to John Rosenthal.
Well, good morning, everyone. Thank you, Jim, for having me here. When Carolyn Wu, the dean of the business school, first invited me here, I wondered why in the world she ever did such a thing. I am not a quant. I am not in the league or caliber with Professor Schultz. I am probably 180 degrees opposite of a quant. I think that we learned some important lessons from the video. In fact, I think there are several semesters of coursework embedded in the video that you could all research. There's some PhD theses in there. But I think I'd like to make just a few comments. We were asked to speak about the future of capitalism. What's next? How is the world going to evolve from here? I happen to be a guy who very much believes in the whole concept of trust. I think trust is experiential. In the absence of experience, trust becomes hope. Trust only becomes a wish or a hope. A lot of financial markets exist on the concept of trust. Sometimes they fail when that trust is betrayed. So I think that if we have a long-standing experience in a particular market, and you can understand how your counterparty is going to behave, then your trust is well-founded. I know a dear friend of mine who trades with third world countries. They don't deserve to be creditworthy as you and I would think about it, yet he has a 25-year history of trading with these people. He knows their financial records. He knows how they have performed in the past, and therefore he has a reason to trust them. He doesn't trade on letters of credit, but rather on open account. As Jim described in my introduction, I am a community banker by training and by practice. Our particular community bank not only practice the art of underwriting loans, but also the science. We did both the quantitative work, but the art part. And that art part evolves around a lot of the concepts of trust. In our 11-year history as a bank, we had only one loan charge-off, which is almost unheard of. And it's not because we were such great quantitative analyzers of financial statements. It's because we sat across the table from people and we talked to them. We looked into their eyes. We looked into their soul to see whether or not they, A, had a good idea, and B, were they honorable? Were they going to do what they said they were going to do? Would they sacrifice like the greatest generation sacrificed, like the Chinese people sacrifice in order to honor their obligations? What I am doing now, I share with you not to make a sales pitch, but to give you an idea of what I think the future of capitalism is. I am a firm believer in capitalism. Our group is in fact starting a limited partnership arrangement in which we are inviting our friends to invest with us in certain types of community banks. I think the pendulum is swinging away from big banks. There are so many entities. This whole notion of too big to fail does cause increased volatility in markets and does cause bailouts to have to occur. I'm a great believer in community banks. I think community bankers know their clients particularly well and can sit across from them and evaluate them. But I'm not looking just to invest in community banks. I'm looking to invest in a particular kind of community bank. The kind of community bank that is very interested in taking care of all of the different constituents it serves. If any company, whether it's a bank or a widget maker, is solely focused on one of their constituents, I believe they're doomed to failure. The role of management, the role of the chief executive in any firm, in my opinion, is really the chief arbitrator of fairness between the different constituents that they serve. And that's hard work, because the objectives or desires of the shareholders can sometimes be in the opposite direction or at odds with what's in the best interest of the clients, or what's best for an employee may, if pay is appropriate, may reduce the overall profits of a company, what's best from a regulatory standpoint, or what's best from a community standpoint. These are all things that are conflicting needs that the company needs to make. And chief executive officers and management teams need to arbitrate among those groups fairly, in my opinion. I think that there will be a resurgence of a focus on clients or customers. Value is created, enterprise value is created, not by magical formula or pixie dust, but rather serving clients in a way that they have a win, something good comes to them, and that you can profit from that interchange. So I think there's a lot of articles out there. One of the Bibles that I use, that I discovered a long time ago, was this particular book called The Loyalty Effect. And it talks about the very intricate and complicated interrelationship between the company and all of its different constituents. And in true fact, I think some of the best companies that have produced long-term shareholder value over a many-year period of time are the kinds of companies that practice loyalty-based principles. So our future of capitalism, in terms of the $15 million plus of money that we've attracted to our limited partnerships, is throwing in with us or investing with us because they trust that our group can identify banks, community banks specifically, that will in fact differentiate themselves by really knowing their clients particularly well. I know again that the only thing standing between you and lunch is me. I think we're supposed to have a few questions. I don't know whether we have time for that, but I think with my final comment is that I'm not a quant. I'm more in the Soros camp. I think judgments and some intuitions and some taking the measure of your counterparty will help you become a better investor in the long run. I do think that the video is actually worth seeing more than once. I've had the chance to see it several times, and each time I see it, I pick up a new piece of wisdom. So I do think it was worthwhile. Thank you very much.
Let me ask if you've got a few questions. We have just a couple of minutes left. So if there are any questions, now is the moment. Let me pose one for Professor Schultz. I'm still curious about the president's proposal last week to restrict commercial banks from owning hedge funds and from trading from their own proprietary funds, that is, taking risk with the depositors' money. First, is this just populist rhetoric, or is this actually going to happen, Paul? Secondly, is it likely to work?
A few things. It's certainly not populist rhetoric. Taxing banks. The problem is not taking risks with the depositors' money. The problem is taking risks with the depositors' money and the government insurance. Just speak up. I'm sorry. Oh, I'm sorry. Yeah, the problem is not taking. Oh, yeah. Very good. The problem is not taking risk with the depositors' money. It's taking risk with the depositors' money and having the government offer to pay for that. Okay, that's the problem. And I think that's reasonable. On the other hand, I don't really think that any of our recent problems are due at all to proprietary trading on the part of banks. I can't think of any real notable examples on that. So I have
John, any thoughts on
the
same question?
Well, it is popular to take shots at banks right now. We're kind of synonymous with lawyers in many ways. But truly, the economy is going to recover when banks get more confidence to start being able to lend. There's a terrible oxymoronic situation going on. The government is not coordinated. The regulatory arm of the government is saying, be careful, You have to lend only to those that are creditworthy. Don't take risk. Watch out, make sure your cash flows are good. They don't say, look at the measure of the person, look at the character. Has he had a historic good run? Maybe he's in some rough times right now. Has he worked his way out of it before? So the regulatory arm of the government is saying no, no, no. And the political side of the government is saying it's these lousy banks that aren't lending. You know, they're evil, they're hoarding their money, they're making money because of the steepness of the yield curve right now, et cetera. So there needs to be kind of a more centralized approach, and I don't have any idea how to achieve that. I do think that in politics, like within everything, the pendulums swing back and forth. The pendulums swing back and forth. I happen to be a free markets guy. I happen to believe very much in free markets. You would expect that I would be a Republican, and I am. I think we need a new articulate Republican that can espouse conservative virtues. I'm panicked about inflation. The way we've printed money is a very dangerous thing. I think the Chinese are going to stop investing in us. I think all of the world is going to stop investing in us, which is by its nature going to drive up the cost of money. And the bond markets will react to this fact that the monies aren't flowing in from all over the world. It's really a supply and demand dynamic more than it is that some guy in New York is sitting there controlling the bond market.
One last question. Mr. Murphy, if you would wait for the microphone so we can capture that.
Okay.
To the professor, how would you grade the accuracy of that video by the Harvard professor, 100 being the highest?
I'm sorry, say that again.
He's interested in knowing if you could assign a grade to Professor Ferguson's lecture.
Its accuracy.
I'd give it an A on form and a C on content.
Okay. Thank you.
He didn't ask me, but I think there's a lot of worth in the video. I agree that there's a lot of sensationalism in there, and there's some glitz. But as I said, there are several semesters worth of coursework. I mean, just dissecting the failure of Enron, the failure of long-term capital management, the operation of markets. And Professor and I may disagree on one thing. I think that fear and exuberance do play a role in market cycles. I agree that core fundamental earnings are the key determinant of stock prices, but there can be a herd mentality. And there's a lot of people that in this world are anxious to make a quick buck or get rich quick, and they're uninformed or hoping. They're not basing their trust on experience, but they're hoping to get rich quick. It's like winning the lottery. And so there are a lot of people that will jump into an Enron stock because their neighbor or their friend has boasted to them about how much money they've made and how much they've been able to buy a yacht. So while it is not the sole contributing factor, I do think emotion, both positive and negative emotions, do contribute to the overall market performance.
Ladies and gentlemen, please help me thank our two guests for today.
Thank you.